have been covering some of the best ETFs for maximizing dividend income, and majority of them use option strategies like covered calls to generate exceptionally high yields, making them ideal for income-focused investors and retirees. Now, one of the most attractive aspects of these ETFs is not only the high level of income, but also the frequency of dividend distributions. The most frequent dividend distributions from ETFs that I've covered were on a monthly basis. And for retirees and income investors, this can be a dream investment because the more frequent the dividend distributions, the more investors are able to dollar cost average and capitalize on compounding growth. And now there's a new series of ETFs that distribute dividends on a weekly basis, completely transforming passive income generation for dividend investors. Weekly passive income generation can create a game-changing boost for portfolio returns. And there's one particular ETF that stands out the most. And with a dividend yield of around 30%, it has been gaining a lot of attention. And the craziest part is that the ETF does not own any shares. And this brings me to QDTE, which is the Roundhill Innovation 100 Zero DTE Covered Call Strategy ETF. And the reason I specifically want to focus on this ETF today is because the fund just distributed a record-breaking dividend that was almost 5 times its average, showcasing how effective its strategy can be during times of heightened volatility. If you guys are enjoying this content and find it helpful, please do me a little favor and hit that thumbs up button for the YouTube algorithm. It really helps out my channel and I really appreciate it. So thank you guys so much. Let's move on. So to begin, let's first run through the fundamentals of the ETF so that you can get a better understanding before moving forward. QDTE was established on March 7th, 2024 and has over $600 million of assets under management, which is very impressive considering that it's only been around for about 9 months. Now, QDTE has an expense ratio of around 1%, which is very high, but you'll understand why it's so expensive in just a bit. Since inception, the ETF has been able to slightly outperform the QQQ and has slightly outperformed the S&P 500 as well. Now, if we're going to compare this ETF to any benchmark ETF, it has to be the QQQ because its option strategy is on the Nasdaq 100. Just looking at its performance relative to the QQQ, the fact that it's actually been able to outperform is very intriguing because most high-income covered call ETFs on the Nasdaq 100 will typically lag behind. Now, when you look at the fund's holding breakdown, you see no shares of stock, but instead you only see Nasdaq call options and treasury bonds. The treasury bond provides extra income. So let's get to the main question. How does this ETF work and how is it able to generate a 30% annual dividend yield and distribute it on a weekly basis? To put everything in very simple terms, this ETF is essentially a poor man's covered call strategy on the Nasdaq 100 wrapped in an ETF. But what's interesting is that the fund managers are selling zero DTE call options on the Nasdaq 100 every single day. So let's break that down. The poor man's covered call is a strategy that mimics a traditional covered call strategy, but it requires a lot less capital. Very important to remember. And the way it works is very simple. Instead of buying and holding shares of stock and then selling calls against them like most covered call ETFs, the fund purchases a long-dated in-the-money call option, otherwise known as a LEAP. So, for example, instead of buying 100 shares of the QQQ, I would purchase a call option with an expiration date of 1 to 2 years. And this essentially acts as a substitute for owning the stock. And when you look at the fund's holding breakdown, you see that the call options on the Nasdaq 100 are all expiring in 2025. Now, there are 3 LEAPs purchased here, and I'll explain why in just a second. Now, my number one source of economic data, comparison charts, fund details, market updates, and finding a strong investment is Seeking Alpha, and I highly suggest to use this platform. And right now, you can use my link to get $30 off their premium plan. So take advantage of it before it's gone. There are 2 very important factors that we have to discuss here. Number 1, these LEAPs are purchased deep in the money. So the strike price of the call options that are purchased as LEAPs are well below the current trading price of the Nasdaq 100. And there are several reasons the fund does this. For one, deep in the money LEAPs typically have a delta that is close to 1. And delta is an options graph that represents how much an options price changes in relation to the underlying asset's price. So the closer the number is to 1, means that the option contract is moving almost dollar for dollar with the Nasdaq 100. This makes the price fluctuations behave very similarly to owning the stock itself. But like I said, it requires a lot less capital. But remember that this ETF is purchasing these LEAPs on the Nasdaq 100 index. So there are no shares involved and everything is settled with cash. Also, deep in the money call options experience a lot less time decay, otherwise known as theta decay. And theta decay is what decreases the value of an option contract as it approaches its expiration. And the closer and closer an option contract gets to its expiration, the more pronounced the effect of theta decay becomes. So for an ETF that wants to replace owning shares with LEAPs, you don't want theta decay to be a problem. Now circling back to QDTE, the fund managers have 3 sets of LEAPs, each expiring at a further date in order to avoid the impact of theta decay, but to also maintain exposure to the underlying index. Now, the reason the fund managers are doing this is likely because they want to have more capital available to sell call options, so that they would be able to generate a lot of premium income. All right, so now that you understand what leaps are, we have to talk about the fund's covered call strategy. This fund is selling 0 DTE call options on the NASDAQ 100. And all this means is that the call options have 0 days to expiration. Now, the most important thing to keep in mind about 0 DTE call options is that the fund managers are trying to capture premium income on a daily basis. And this is very different from typical covered call ETFs like JEPQ, which sell call options that are 30 days to expiration.